Call the meeting to order. It is Friday, July 29th, 2016, and the time is 10:31 a.m. The board meeting, there is a quorum is present. The meeting has been duly called and notice of the meeting was posted as required by law. Do we have anything to go into closed session for?
We do not.
Not, so we will not go into closed session. So call the meeting to order.
All right. There's one consent item. It's approve a change of address amendment. This is the Quest Middle School that we discussed with you guys several months ago, merging Coppell with Quest Louisville. So that merger's happened this summer. The kids will be together in the fall. And so we have the campus number for Quest Middle School of Coppell. And instead of returning that to the state, we want to keep that open for use in other places. So this is just a change of address, moving that number to it's actually going to the Vista in Coppell, or the Coppell Classical. So real simple consent item. We're asking you to approve this one consent item.
Any questions on that? Do I hear a motion to approve the consent? Motion made by Dan Madalena. Do I hear a second? Second. Second by Ken Sparks. All in favor?
Aye.
Aye. That passes unanimously. So the motion is approved.
Okay.
So do you want to do separate items first, or do you want to do discussion items?
Can we do discussion?
Sure.
Since they're related to the actual separate items? I've told a couple of you, you've asked how much time this is going to take. We're planning an hour. If you need more time, you want to ask more questions, please do. But it doesn't need to be more than an hour unless you want it to be. We issued another bond last year. Took a lot longer last year because these documents were new to us. I appreciate James and his team. They put together a summary of the changes to these documents. So we're hoping you spend time looking through the documents, especially the summary of the changes that were made. What I want to say before I turn it over to James to talk about all these various items is a couple of things. You look at, and for the people online, what is this called?
So it's the bond summary information package that, so it's PDF bond summary information.
You have this, Sarah.
Not summary of changes, but in the discussion, there you go. And whoops, nope, go back up. Sorry, I have to look through this one.
Probably.
I'm sorry, it's bond project overview. Bond project overview, my fault. I have
And if you would go to, if y'all would note page 11, got new contacts and they're not working that great for reading. So
we're going to go all the way to Sarah.
I have a page, you have page numbers.
That's what I'm looking
Yeah, probably not. Separate time.
Page 11.
for. 7.
You don't think it'll shut this other thing off? Is it connected? Yep.
That's it.
Can you still hear us online?
Yes.
All right. Okay. So the notice on this document, this shows all of the projects that were, it shows all the projects that will be in this bond, this financing package. And you'll notice from Coppell down to North Frisco, you'll notice all of those have a date for approval by the board. So these have been brought to the board. You've approved these projects. You've approved the financing of these properties. The 4 that have not been brought to the board, one of them, Amarillo, at the top, is being discussed today. And then the other 3, well, let me jump down to Tyler. Tyler, you've already approved the land purchase, but we have not had you approve the buildings being built on the property. And in the remaining 2, you see above Tyler, you see the Premier High School of San Antonio, $1.5 million. That is going to be our first model Premier that we build out. We're leasing that facility right now. We would attempt to purchase that, and then it would be our first premier that we own. The second from the top, Carrollton Classical Academy. We discussed all these properties when we talked about the 6-year plan, and we have work to do to bring back to you for years 2 through 6. But that first year that was listed as 2016, we're discussing today these items. So I wanted to just make sure before James started talking about all the details on the financing that you had a big picture of these are things you've approved, these are the dates you approved them, except for the 4 I just mentioned, and that's about 20% of this total bond. So 80% of it you've already approved. Today we're asking you to approve a few more items that'll total the $68 million, which is the total of the bond package. Okay. So before James jumps in, do you have any questions on that? We discussed this in the 6-year plan as year 1. There's work that you guys have brought up, things you want to know for years 2 through 5 that will be, 2 through 6 that we'll be having additional meetings on. Most of this, 80% of this, you've approved building it and financing, and this is as you'll see, this is the best way to finance it financially on the interest rate. So we're glad that additional money was freed up in the permanent school fund that we can have access to that's going to really reduce our interest rate. Any questions on the projects themselves? Okay, I hope that helps, that overview. Second thing I want to note is we mentioned to you that we were going to submit to the state, I think it was $98 million approval, up to $98 million, and we got approval for that, and we want you guys to know we're being conservative on this. We're not asking you to approve $98 million. So we've dropped off by $30 million. Yes, sir.
Let me give you one update there. We actually asked you to approve a request for, I believe it was $150 million, in anticipation that they would not provide, they would not grant us the full amount.
Right.
We were granted $98 million. And so that's what we have available to us in the, for the permanent school fund.
All right, so I just wanted to mention that to you guys so you understand the conservative nature that we as administration are taking in moving forward with these buildings. I think you'll find as James goes through these items, when you see some of our friends in the charter market and what they're doing, and you see how much they've issued, we're being very conservative. And I think you find with our rating with S&P, they acknowledge that and realize that we're building buildings once we've already shown capacity, once we've already shown how many kids are interested, once we've already built out, a third to half of the school. So very low risk compared to some of our competitors where they go out and they just build new buildings in a new market, and it's worked out fine, but it's still somewhat risky for bondholders that, are these areas, going to be positive like they've been in their current markets.
So I know the rating is another item here. You got that on Wednesday?
We got the reaffirmation Wednesday.
We received that. It was and then it was published yesterday on Thursday.
Okay, right. And it's
And
state
you should
flat.
have that here.
State flat.
What we would
And that's
expect it.
exactly.
Right. So let's start with that. James, I'm going to turn over these items to you, but we'll start with S&P rating report.
Right, and that's
I stole the thunder. I'm sorry.
well, that's okay. Before we can just to summarize for folks, before we can issue a bond under the PSF, the Permanent School Fund, the state requires that we apply for and receive a rating that is considered investment grade, which is BBB- or above. We definitely want the Permanent School Fund, because what that does is it puts the state's guarantee behind our bond and gives us an effective AAA rating. So we obviously want that. So we went to S&P last year before we issued the 2015 series, and they gave us a BBB flat rating. That is, again, other than, and Clarence, correct me if I'm wrong, but other than the Washington, D.C. KIP at BBB+, BBB flat is pretty much the best. It's the best that's out there in the charter industry. So that was fantastic. We went back to them again this year in anticipation of issuing a bond, and they reaffirmed our BBB flat rating. They gave us, again, Chuck said a couple of things. They very much like the fact that we have been conservative with our debt, that we have used leases to start, such that we had the flexibility to adjust our financial picture based on our organization and our business needs, and then started moving into, with proven sites, proven schools, started moving into actually purchasing or building buildings. And so they like that. They like that very much. As we go through, I'll go further, and I'll do take you back to a table that you saw at a previous meeting that shows kind of our debt as compared to some of our competitors. But that was very significant. We have 2 times debt coverage, which were required 1.1 times for the PSF and in our covenants. So we do have some capacity there, but as we grow, we would expect that to increase as well. But which will then allow us to, as needed, again from business perspective, add debt as needed for business purposes. So I was very positive. Each of you here have a copy of the S&P ratings report. It gives a nice summary of the report. Has that been uploaded to Dropbox? So I just received the final report, the true final this morning.
Okay,
I got one last night, and then they sent the final this morning. So I'm not sure if that got uploaded. We'll upload that to the Dropbox so that you have a final copy of the ratings report.
Is that one you sent me?
It is. That was last night. They sent another one this morning, which was kind of the
email. Who would have it?
So
Michelle, can you call Liz? Liz has it.
Liz has it.
And Liz has the Lance and Marvin's emails.
Yes, she would.
All right, let's do that.
So we will do that shortly.
You're going to text Liz, right?
Yeah.
You go ahead, and I'll go talk to Liz.
Okay, if you would, that'll work. All right. So it's a very positive rating. The things that they look at negatively on us, in the sense, when I say negatively, risks, general risks. They look at our alternative ed program and the fact that the students tend to be a little more mobile. They shift. They come into the program and out of the program. We have, and they note that we have maintained significant stability in our enrollment within the Premier, specifically within our Premier program. And so they were positive about that, but they said one of the risks is our ability to be able to maintain that population. They also put it as a risk, our virtual program, and the fact that it is a large portion of our population. They do recognize, and they recognize in the report, that we are using the proceeds of that program to develop our curriculum internally, and that we are not using it for required operational needs for the brick and mortar campuses. So they do note that, but they do note both of those as potential risks. Anyway, this is very positive. I'm very pleased, and I wanted to share that with you. So we needed to complete this prior to being able to participate in the PSF. So we have done so. We've completed that. So we will be able to. We have the opportunity to use the PSF funds going forward. So I wanted to note that. Moving kind of to the next step in the discussion items is to start talking about the bond. So does anybody have any questions regarding the S&P rating or the report at this point? And we'll get that uploaded into the Dropbox for you so you can take a look at that. What I'd like to do then is just go through some of the documents. I want to start with the overview that you had. We have the PDF overview that No, the one that you had up to begin with Chuck. It was, yeah, under the bond. And each of you here have a physical copy available to you. The majority of this you had since last Saturday. We did receive a ratings update from a trustee proposal from Regions, which was placed in the back of this document, and it is available online as well. What I'd like to do, if possible, is go to page 2, which is the debt overview, and start there and just take a look at kind of our current debt situation. As we look as an organization at expanding, obviously we have the opportunity to use cash, our operating cash. We have the opportunity to use bank loans, and we have limited opportunity to use bond. Well, we have the opportunity to use bond financing. We have a limited opportunity to use the PSF, which is enhanced bond financing. So this is an opportunity that for us is not something that is just out there all of the time. The PSF has a limited dollar amount, and we actually reached that limit at the end of last year. Oops, did we lose line?
Sorry, it lost connection for whatever reason. The internet. It's back up.
So we back? Okay.
We're okay. We're okay.
Okay. Good.
Yeah, got you back.
So with the with the bank financing, we'll see here, it has limited capacity in that depending upon who we're using, has potential for limited capacity, has limited capacity as to how much they can loan to a particular entity. But we can get around that by going with a larger institution. The thing we can't get around is the fact that the terms that they give us. And so we're going to take a look at that as we take a look just kind of as at the debt that we have, and look at a comparison of kind of the bond financing versus bank financing. So looking at page 2, you can see what we currently have in the first table in the overview. We have, to start with, what we currently have. We have bank debt currently of about $7.5 million. These are properties that are owned by our 501c3 that are not part of our charter assets. So they're part of our 501c3 assets, but not part of our charter assets. The reason we purchased these with the 501c3 separately was because there was there were buildings in which either they had tenants that were we already had leases for multiple years, or we did not have the need for the full use of the building, so we did plan to lease out the remaining portion of the building until we had need for that. So this would be our 700 Parker Square, our building here on Lakeway. We actually do operate 2 schools, but about half of it is leased out, and then our building at then Hardin Road in Arkansas that we own. So that's the bank debt that we have. We actually have reasonably favorable terms. We have a fixed rate at 5.25% over 15 years, so it is fixed. It will not change. We can get better rates if we're willing to let it float, but given the low interest rate environment, we've decided to stay with the fixed rate and lock that in for the period of time. Our cash flow is such that we can handle the slightly higher payments that we would have in the near term, and general market outlook we'd expect over the next few years for rates to be rising in some sense. So that's our current bank debt. We have, last year we issued about $66 million, $65 to $66 million in bond issuance, in which we refinanced a significant portion of our bank debt, and we provided for some additions to some of our properties. You can see those here. We did those in 2 series, the 2015A and the 2015B. Those are financed at about 4% even as an effective rate over 30 years. That is a fantastic rate for us. given that is fixed. It is taking advantage of the PSF that we are looking to take advantage of this time around as well. Now, the next line, 2016, we are looking at a $68 million issuance. As Chuck mentioned, the majority of that are projects that have already been approved. There's about $10 million of that has not yet been approved by the board, but which we believe is strategic for the organization. At this point in time, I'm going to let Clarence talk about the true interest rate in a little bit, about the true interest rate environment right now. But we believe, and I'm going to look at Clarence and see if it's true, that we believe we can get a little bit better rate than we did last year. And so you see it here as targeting a 3.8% over the 30 years. We've had a little bit of up and down over the course of the last year, but in the last few months we've had a drop off. We had a steep drop off with the Brexit, but that's come back and stabilized. And so, but we have had a drop off the last few months. So we believe if the rate remains stable until we price, that we will actually receive a slightly better rate than we did a year ago. So our options right now really are the bond financing and the bank loan for handling expansion. If we look at the $68 million, you can see in the second table there, and looking the bank loan versus the bond financing. Bank loan includes we have to put down 20% cash right up front. We really can't get better than that. We look at the 5.25% over 15 years, which is our best and longest term we can fix the rate. We see that given the $68 million and our expected 3.8% financing of the bank loan, if we assume a 5% discount rate, we look at almost $15 million gain in the net present value of our cash flows, or our future cash flows, over the course of the life of the bond and the loan in comparison. Obviously, this is a very significant value to the company, and the 5% discount rate is based on the benefit of having that cash available to us for operations. Are there any questions regarding that? I wanted to go through that just to give you a good sense of kind of what we're looking at, what our options are, and why we're really looking at the bond financing and why it's advantageous to us. Okay, I'm going to run past. What I'd like to do then is, you've had a chance. I wanted to spend some time there, and I did spend some significant time there. Now we're gonna go more in just a general overview and just see if you have questions as we go through here. But the next page goes to the kind of shows our debt as it plays out over the next few years in total costs. This breaks it down again with the first portion with the 2015 bond and our 501c3 loans, and then the addition of the 2016 bond, potential 2016 bond in the second table. So if you have any questions, just jump in and ask. At the end of the day, what we're going to be asking today is for the board to approve offering this $68 million PSF-backed bond to the public. Today is your day to say yes, no, or wait. The issue I'd have with the wait, not the issue, but the limitations we have with the wait is that once we receive approval from the state, we have 6 months in which to issue the bond. If we do not close the bond within the 6 months, then we lose our PSF eligibility for those funds, and those would be put back in the pool.
And interest rates are likely.
And then interest rates are likely to go up, to increase.
Of course,
Yes, we have.
but I think it's more likely.
I have a question.
Yes, Lance.
Maybe Chuck, could you put this in bond issuance and new debt in the context of the 5-year plan that we looked at it in our last meeting. Is this is a piece of that, I assume? There would be more to come within the 5-year plan. Just where does it fit in that?
Yeah.
And then can I just add a follow-on to that? Because that's a good question. It's the $14 million in the cash flow. And is that, we have that earmarked already for the purpose of or is it for some other?
It would be, the benefit would be toward the growth, and it is not earmarked. I'm not going to say it's earmarked at this point in time, but the expectation is this would then help us with our future growth. And
It
most
moves into
likely,
reserve, yeah.
it becomes reserve, and then as you look at that plan, what we're really looking at here is we're really looking at the first year of that plan. So I would expect that probably in a couple of years we would come back and hopefully have more PSF and look to then fund another set of
And to
projects.
Lance's question, it was the overall plan was over 300 million in addition to the 65 million.
Correct.
66 million. 66 million. So this is a portion of it. This is year 1 out of 6 years. We are, as we mentioned to you when we were talking about the 6-year plan, obviously the 2016 we needed to move on. The other thing is we need to come back to you guys based on the questions, very good questions you ask about the capacity of the corporation, the district office to be able to handle that kind of growth. So we'll be having another meeting, a follow-up meeting that'll be a 4 or 5 hour meeting in the fall to discuss those aspects. So hopefully we can give you a comfort level on moving forward on year 2 through 6 and the remainder of the 300 million.
And am I correct in assuming that when we authorize this, we're not biting off more than the projects that we're authorizing? There's no part of this, for instance, that okay, now we've started the ball rolling on something, and ultimately we're committing ourselves to this, but we're really committing ourselves to 5 more years of continued financing.
Right. Yeah.
I guess the question is are there any commitments kind of beyond this project that are hidden?
Yeah, there's none. So the debt coverage and what you see in the S&P report and what you'll see is we're going through the financials showing debt coverage. That's on the 68 million we're asking you to approve us moving forward with, plus the 66 million, and then the bank note was the remaining bank notes are
About 7.5 million.
8 million. So 7.5 million. So that total is 140.
Yeah, it's about
141. So that's all you're lighting off right now is the 141. That's right.
Yeah. Okay. Good. Thank you.
Good question.
Yeah, it's a great question. So I just want to put this in context as we were talking that at the end of the day, that's what we're really asking for and requesting as part of your approval today. Because once we go through today, we will move into the pricing, and we'll basically be offering it to the public. So this is the day to make the decision to say, yeah, we really want to put this in front of the public and offer it or not. And so that's what I just want to make it clear that that's what we're asking today. So this is basically the day where we say, yep, we're committing to going forward with this bond.
And at this point, I would say really what the board should be considering is really just the 10 million that we've not discussed recently as specific projects. We've talked about it in the 6-year plan for year 1, but 80% of this you already approved, and you've approved the financing, and this financing makes so much more sense than anything else. So obviously you can do anything you want today, but if you were going to decide to back off anything, I would see it as it's really just that extra 10 million that we've not specifically requested approval for up until this point. Keep in mind, as we talked about in our planning session, keep in mind that, these are obviously big numbers to me. They're probably not real big if you're in banking like some of you guys where it's billions and billions of dollars, but it's big to me, and to some of us, I'm sure it's big numbers. But you consider the demand we have from these students. You consider the cash flow from the state and not having to do go track down people because we're in sales and we're selling product and we don't know if people are going to pay. I mean, the state's paying; they're going to pay us. Risks seem very low from how we look at it, and the fact that there's demand, people want their kids in. We have waiting lists, more kids want in, and in the end, that last piece, we wouldn't be driven just by this, but the last piece is, if we don't do it, if we don't expand to where we can serve these students, they will go somewhere else. Other people will build in our backyard, and they will be serving the kids. And maybe we're okay with that. But, that's something to consider, is somebody's going to serve these kids.
Thank you. Okay, so I'm going to go off just kind of this debt summary piece and go to the bond projects, which would be page 5 and 6. This is a summary of the bond project as we see them, breakdown of how we are looking to allocate the funds. Yep, that's it. And you can see that it's a combination of the new construction and purchase going forward in the top sections, and then it goes into refunding resolutions. And these are areas where we have where we either have purchased or expect to purchase the properties in anticipation of the bond, and would then refund it back to ourselves as cash.
You mentioned page 4. You talking about that? I mentioned it. I don't know if you went in depth when I was downstairs. But our friends, our competitors, how much they've issued.
Yeah, I know we didn't talk about it.
Whoops, I went past it. You know why? Because I just slipped past it. My fault. My fault. It was stuck to the other page. Can I go back to page 4? There you go. Thank you, Chuck.
Sorry, I had a question related to this.
Yes.
Think about as you're talking about this. Are there S&P ratings equal to?
They're consistent. They're triple B flat.
Yeah, he is the only triple B. The others, I believe, are all
Triple B minus.
Oh, everybody's triple B. Okay, sorry.
KIPP is triple B
Yeah,
flat?
might be, no, everybody should. Yeah, triple B minus.
It's just KIPP in Washington.
The others triple
KIPP Washington is triple B
Right,
flat.
so KIPP,
A small KIPP.
KIPP Houston, and so that's triple B minus, right.
Now,
Here is
was it
triple B
Uplift that
minus, and
moved
then the
down?
other triple B flat.
Uplift is triple B minus.
I thought they were double. They're not double B.
No,
Uplift. Okay.
no. They,
So these are all at least triple B minus.
all of them would qualify for
Right.
CSL.
Idea, and you're thinking Idea and Harmony are triple B flat, KIPP's
That's
triple B
correct.
minus, and then we're triple B flat. And so looking at the market comparison, we have just looking at debt as a percentage of revenue, because ultimately, you're going to be covering your debt with your incoming revenue. Our current, as we stand today, we're looking at about 53% debt to revenue, annual revenue ratio. If you look at our competitors, Idea, Harmony, KIPP, they're all Harmony's the best at 122%, 123%, and then the other, both KIPP and Idea, are over 140%. If we add the 68 million, that takes us to about 89%. So we're still significantly below, and we're still significantly below our competitors in that regard. And we're just talking today that I know Idea is looking to add, and each of these, I assume they have their own metrics and they grow each year. So I don't know how it might change next year, but I know that as they grow, they need to build. And so they have a model that requires them to go build new facilities and add on that debt to grow.
But our number here goes up to 40. That's what we said in the earlier.
It is. I was looking specifically at the bond debt.
Just bonds.
I was looking at those
But it still goes up, right? Because
That's correct.
That's
it
right.
goes up at least 68 or.
Yeah. So the total bond debt ends up at 134 million.
This is everything except the 7.5.
That's right. So it's everything but the 7.5. That's exactly right.
Right. So but that will put us at 100, a little over 100% of
The revenue's also.
No, the revenue, projected revenue is 151.
51, right, so we're
151.
still below the 100.
So we're still below.
That's a number I like to stay below.
Yep, and I understand that. Makes sense.
Okay. Because these guys are way over.
They're way over, yeah.
And Harmony's pretty good.
Do we have a simple or a similar comparison of bond debt as a factor of assets?
I can get that for you. I don't have it right at the moment, but
We can do that.
Do we have the figures on the other companies as well?
yeah, I
You
can get that.
It's
I can
just
get that
more
for you.
work to
Very
put
easy.
together through with their filings. But,
Right, exactly. But we definitely would have that available to us to figure that out.
Put that out.
Absolutely.
I mean,
That'd be interesting to see as well.
I would also think that that would be in the S&P report stuff too. For us.
It is.
right?
It is.
Right.
It is for us. I just have to chase down for the others. Not that difficult.
Assume that's a pretty high number for us. But debt to equity. I mean, our equity is debt is. That is what. If I remember correctly, we have assets that are considerably higher than our debt.
Yes, we do. That is correct.
Sorry,
Well,
thank you.
100% sure.
Just takes a while to get out.
Nope, no, you're exactly right. Okay. Any questions on this? Okay. So I want to go past that. Yeah, you can see that we are consistently looking to be as more conservative than our competitors. Okay, so the next page 5, again, looking at the projects, you can see what we're looking to do with the funds. If you have any questions there, please ask. We've kind of run through that Chuck went through a summary of those that have been approved, not approved, versus those that have not. So pages 5 and 6 give that overview. Page 7, I specifically wanted to show what was part of TCPA, Texas College Preparatory, what is part of Premier, and then what would be unallocated. It's just another way to summarize the same information. So it's not nothing new or unique there. After that, this is an actual copy of our TEFRA notice. What I wanted specifically to note here is that while we do declare our bond projects and where we expect to use the funds, we have the ability to use the funds legally based on those locations that we actually TEFRA. Now, what is a TEFRA and why we have to do a TEFRA? I'm not going to try to tell you it's a tax exempt something, and I'm going to go. What is it? What is it, Tom?
Tax equity financial.
Tax equity. Sorry, tax equity. There you go. Finance Reform Act.
What year?
1986.
1986, right?
There you go.
86
Very
tax.
good. Very good. I'm sorry. I use TEFRA so often that it's become a verb as well as a noun. In other words. But in order to use tax exempt proceeds of the bond in a particular location, we actually have to go to the municipality, generally the county, and publicly declare that we plan to use those funds. We have to have a public hearing at the site, and allow input. They give us basically approval to use these tax exempt funds, and so we have to do that in order to issue tax exempt bonds and then use them in a particular site. So in the process of this, as long as we have identified those sites and gone through this process, we can use these bond funds at these locations. And so what we have done is we have gone through that process for all the properties that we own by the charters, as well as we have a few properties that we were looking at the possibility of purchasing in the future that we're currently leasing. And so we added a few, the San Antonio Premier, the Palmview Premier site, and the San Juan Premier site. Each of those are properties we currently leased. So it's all the properties we own plus those properties that we think we may purchase. We are not obligated in any way to spend funds at these sites, but we now have the option. So if for some reason one of the projects did not did not work out the way we intended it to, and we have bond funds available, we would be able to apply them at one of these other sites. And we can apply them for essentially capital expenditures, purchase, expansion, building, or replacement of capital items. So we wanted to provide the most flexibility for us. This reduces our risk if for some reason a project does not work out the way we expect it to, and something blocks us. We don't expect this, but something blocks us or an opportunity falls through. We then have the option to go and use these funds where it would make the most sense for us operationally. You are not approving the expenditure of funds at all these locations. As a project came up, you would be approving that separately at that time. So I want to make that
Let me ask
clear.
Tom a question. So if a school just doesn't make it, Frisco doesn't make it, and there's just not enough kids, and we don't want to run the school anymore, we're going to close it. What are our options? Can we sell the building to a colleague?
Sure. There are a couple different things we could do. Obviously, you can liquidate the asset. You sell the building to any number of folks. There's slightly different treatment of the proceeds if it's another 501c3 or government versus a for-profit. Let's assume it's a for-profit. You sell it to Walmart, and they want to come in here and put a building on that site. We would need to take the proceeds in that case, and you could use those proceeds from the sale for anyone at any one of these Tefred sites, or we pay off bonds. Those are your options. So you could take the money and build gymnasiums at several sites or whatever you'd like to do.
So obviously that lowers our risk of we take one of these new sites and something doesn't work, and then we need to move the money somewhere else.
Right.
And at what point can we start paying off the bond? Is it 10 years?
We are going to have a 10-year call.
Yeah,
But we would, in that case, we'd have to do defeasance, which is kind of to escrow the funds to prepay bonds ahead of the redemption. Generally, in cases where we've sold properties on organizations your size, I've never seen an organization your size that doesn't have a lot of need, and you already borrowed the money, and it's usually much more efficient to use it for other capital expenditures rather than debt.
Okay. Thank you.
Appreciate that. All right, so any questions in regards to the projects? Okay, then if we can go to page 11, where this is the one that Chuck went through. I'm not earlier. And you can take a look at this and you can see the bond amount that we have applied. You can see the amount that we will reimburse from the bond, given where we are today, back to the company. So these are things that we will have paid out cash and we'll be looking to reimburse immediately to the company. And then you can see the approvals that have been done by the board in the next couple columns, the date and the amounts, and then the difference between the bond amounts and what has been approved by the board. So any questions on this? I don't, since we've kind of been through it once, I don't want to spend any extra time than somebody would like at this point. Okay. So after that, just provides the TEA's letters. This is informational for you to show that the TEA did approve the 98 million, 97.8 million actually, but the 98 million for us to be part of the PSF program. And we received that from TEA. I'm going to go past some of the documentation TEA provides us for completion use of the PSF. All right. After that, it goes into the payment schedules. I am not going to spend any time on the payment schedules. I just let you guys, as much as you want to look through and ask, just wanted to see what the payments were and how they play out. So you can see the expected payment schedule for the 2016 series, 2015, the 501c3, the loan schedules that we have available, as well as finally at the end you can see the payment schedule that was used to calculate the cost of the bank loan that was done on the first page. that we looked at. So that's just for your reference, and if you would like to take a look at that at any point in time, feel free. And then finally, you are going to be asked to approve at a separate item. You are going to be asked to approve Regions as the trustee. We currently use Regions as our master and as our trustee, both as a master trustee as well as the trustee for the specific issuance of the 2015 bond. They are also our dissemination agent, and so we.
When you say dissemination,
paying agent. Sorry, I should. Yes.
Okay.
Yep. And so I am. We are requesting that we use Regions as the trustee for the 2016 bond as well, which then simplifies much of our administration of the bond.
Certainly simplifies it for me because if you get Wells Fargo in trouble. I head up their corporate trust.
I'm sure.
Risk, legal, compliance, all that stuff. So rates, I'd have to quit.
You have to quit.
Yeah.
So can I? Oh,
They're cheap. I mean, yeah. Wow. I said quit Regions, not the board.
yeah. Oh, yeah.
Yeah.
Oh.
I
Quit Wells Fargo.
Give up my job. Why? I mean, Regions is cheap.
Overall, they are actually. They are.
Are they just trying to keep the business, or?
I think so. We're seeing some consolidation in the paying agent, trustee department. Of course, Wells Fargo and Bank of New York are the major players in Regions trying to make a name for themselves, and so we're seeing that more and more of those very competitive bids. We talked about the quality. Obviously, you're a big organization. You don't want to waste your administrator's time chasing out invoices. So we asked about how they performed over the last year, and James's report has been very satisfactory.
Yeah, even though they closed the Dallas office.
They closed it, and that's what we talked. Yeah, we talked
but
about that.
But we so the person we worked with in Dallas shifted to a different company. They obviously are interested in our business, different organization. However, we had a very smooth transition over to the Houston office and gained a new contact, and that went very well. So I have no complaints.
Yeah, I mean, I was supportive of Regions originally. They're a good bank in Alabama.
Right.
And I think the board can always change. Tom, you want to speak to that, but to all the debt portfolio, the bond portfolio, to another trustee.
Oh, absolutely. I mean, we have the ability to change trustees and master trustees whenever you want. So if you're unsatisfied with it at any point, we try to avoid doing it around a debt service payment date.
Yeah.
But otherwise, we're pretty free to do it at any time.
So I'm still.
So this will come up as a separate item, but I wanted to give you a chance to ask questions, let you see just a comparison of costs that we've had, and their proposal is included in the package as well. So I wanted to, at this time, I wanted to shift over and let Clarence just kind of go through the current market environment, and some of the information related, what we can see in relation to our bond expectations for our specific issuance. So he provided a handout. Did this get uploaded? Since you brought your day. Okay, I'm going to. But we're not going to go through page by page, so I don't think that this is going to be as.
No, it won't be. I could just make some general comments.
Please.
Okay, so basically, we have seen a very favorable turn over the since we were in the market last year. A lot of volatility, but where it stands now, it's a good time to be an issuer of bonds in the tax-exempt market. We anticipate, rates to be around the 375, maybe a little lower. It's been kind of bouncing around over the last several weeks, but certainly when you consider the all-in interest cost that we secured last year of 4%. That's which was near the historic lows. 3.75 is almost at historic lows. The good news is that absolute rates are low. The challenge for us would be finding the bond funds and insurance companies and other investors that want to put money to work near all-time lows, because they have to think, what's the downside risk? So they don't have to. There's a lot of money on the sidelines waiting for an uptick in yields, and so it's been fairly common for the permanent school fund or the PSF that to have a remaining bond balance. We expect that to have as much as maybe 15 to 25% or more of the bonds unsold at certain maturities, just because there's a reluctance among investors to put money to work near historic lows. And that's where RBC will make a commitment to underwrite at the market, and like we have done in the past. But that's the expectation for the sale. Obviously, when you have a big name, it may not be as obvious as the state, but when you have a big name like Responsive Education, investors really want to be a part of the credit, just because there's really been a bifurcation in the market between mom and pop, really strong schools versus the more corporate, strategic CMOs, EMOs in the market, management organizations, and they would pay a premium for the expertise that your management group brings to the bear. As it was stated in the S&P report, you have a strong management team, and that's reflective of the BBB rating. And those are the qualitative aspects that help tell the story and to get people involved with the Permanent School Fund Guarantee for charter schools. And so I don't know if there was a Dropbox, but we do have some the impact that Brexit had on interest rates and where we are now in terms of the G7 nations, and we're all kind of, again, we saw near all-time lows. We kind of rebounded a little bit, but I think all in all, we're prepared for it. What happens today would be the posting of a preliminary official statement that would go to a sales force nationally that would then, start fielding questions about, where you've been, where you are, where you're going. And it tells your story specifically in Appendix A of that POS. And just like last year, we anticipate having the school in our offices on the day, I think that's the 10th of August, and then which is Thursday, and then coming to and receiving a verbal commitment once we have a pricing order period from probably about 9 to 11 o'clock. So
did you say pricing on the 5th? Pricing's on the
on the
11th.
Thursday 11th,
Right.
and then Thursday 11th. Thank you. And then then you come back on the 12th and get what we call the written award from the board, which basically signs the bond purchase agreement and authorizes Tom and his legal team to move forward with final approval. But those are the logistics. The closing we anticipate the 24th of August, and we'll be in good shape after that. But I don't know if there are any questions about the market specifically.
Sorry, I got lost a little bit on the dates. Just the interest rate would lock on the 11th on the pricing date, or would it lock after that?
It would actually lock on the Thursday.
Well, it's not going to move. They're going to price the bonds on the 11th, and we'll present that pricing to the board on Friday.
Friday.
So we just hold it overnight.
They'll hold the prices overnight. So they won't float from pricing to the board meeting.
Yeah, and I mean, just my view on interest rates. So the Fed the other day said the economy is less risky, which I think caused a little bit of movement, but not really material movement. The GDP came out today disappointing. Didn't really do much in the stock market, but you've seen what that's done to the bond market.
Yeah, our market lags the taxable market. It's going to have a little impact next week, but there probably is going to be something to offset it. I think the biggest challenge for us is going to be competing deals. I think what stands out here is that the permanent school fund guarantee obviously is traditionally has been involved with guaranteeing school districts' debt, which is backed by an ad valorem tax. And so we find ourselves in a market where yields are just so low, absolute yields are so low. If they come with something that's a little bit different, they get that incremental yield gets a lot of interest. And so to the extent that we could, get in the market and there's not a lot of other PSF, I think we're going to be the only charter school PSF in the market that I think will be well received just because of that incremental yield and really no incremental risk associated with it. So it should be well received.
Okay. And so if I remember correctly, on one of the offerings, you guys had to jump in for a portion.
We anticipate doing the same just because we're going to price it aggressively. We're not, there are two prices out. You can price it to sell or to clear out the inventory, or we have a view of where the market is, and we'll be having a pre-pricing meeting with our underwriter Mark Greer, who's out of our Houston office, will come to Dallas to visit with your staff, and he'll say, here's what we believe is the right price. And we've seen it time and time again, if there are no orders at that price, we tend to stand right behind it because we believe that's just the right price. We're active in the market with a lot of issuers, PSF, non-PSF, charters and non-charters. So we got a good read on where the market should be. We're not interested in pricing to clear the bonds. We're interested in pricing to get the lowest interest rate for you. You're our client. And so that's what we'll do. So what we'll look at other comparables that are in the market, whether they are school districts or not, and just, okay, well, how should we compare to this and review that with your staff, get the approval to go out at those levels, and then try to build a book of business to lower yields and hopefully have more orders. Then we have bonds, then we can make a case to lower the yields at that point.
Okay, good. Thank you.
All right. Good. Any questions for Clarence? Any more questions for Clarence? Okay, what I'm going to do is I'm going to take you back to.
How are we doing on time? It's been an hour. How's everybody on time? Somebody needs to go, I think. And so does anybody want to move anything around, and we'll continue? But we need to move into separate items if people need to leave. And
Yes, we do.
Yeah, I'm good. And I think
Okay, Chuck.
sorry, Lance.
I said I'm doing okay, thanks.
All right. So
Okay.
What else do you have before we get into
So
separate items?
that's really what I have, other than just allowing questions for on the loan documents, because once we start issuing the documents that were in your Dropbox for the loan documents, the master, the trust indenture, sorry, I'm going to go through my list back here. You see the master trust indenture, the bond indenture, the loan agreement, all of those will be the documents that will be applied to this offering. And so while technically you're not approving those today, you would not approve those until the next meeting.
the day after
the pricing, which would be the day after the pricing, correct?
But we can be asking questions in the
You can
next
ask
week,
questions,
right,
exactly.
about those three documents.
Yep. So,
So
but these
you-
will go out. These will go out as addendums to the appendices to the POS. So the market will be seeing them. Okay. So I wanted to give you that option.
And as you go through the documents, I'll just interject, they do have some blanks in there because we do not have the pricing information yet. Obviously, we won't have that till the 11th, and we will bring the completed documents to the board meeting on the 12th.
So if you have any questions, we open. If not, then go to separate items.
Yeah, any feedback from looking at the documents?
I mean, I've looked at them. I need to look at them again. You do tend to fall asleep after.
It's the most exciting reading all
After the
day
first
long.
20 pages, 30 pages, 40 pages.
And I spend a lot of time reading documents, other deals. Yeah, I'm comfortable. This seems to be in good shape. Good shape as it was with the last offering. That was me. From my perspective, of course, the other guys question, but I'm good.
So can we move into separate items?
All right, so how do you just, what are we going to do here? We're just going to approve these or put them up for motion? Any more discussion needs to be had on these? Good.
Nope.
All right, so do I hear a motion to approve separate items 1 through 4?
So moved.
Moved by Lance Losey. Do I hear a second?
Second.
Okay, Dan, not only in a second. All in favor?
Aye.
No opposed?
Aye.
Good, thanks.
And Tom, what do you need on the minutes? Do you need it broken out by each item, or is it okay?
No, that's perfectly fine.
Motion passes unanimously for all separate items under Section D of the agenda. That's good.
All right.
Anything else to talk about?
Nope.
All right, the meeting is adjourned.
Thank you, guys.
Thank you.
Thank you.
Yeah. Thanks,
Appreciate it
guys.
very much.
See you later.
Good to see you all.
Yeah.
Probably do.
Take care.
We can talk about it at the next meeting. Close the agenda probably tonight.